The strength of the U.S. economy in the fourth quarter is more than debatable. When we look at GDP, we have to remember that GDP can be bloated with higher government spending and with lower imports because the contribution of the external sector is higher exports and imports, no? And we have to deduct the imports. So if there's lower imports, it makes it better for GDP. We need to look at the trend in final sales to domestic consumers. Think about this. Look at this chart that is courtesy of Capital Economics. It shows that in 21, the contribution of final sales to private domestic purchasers was significantly higher than that of the overall GDP. And that this contribution of final sales to domestic purchases has been falling and weakening all throughout the period of high inflation, showing that U.S. consumers are feeling the pinch of inflation, that companies are seeing weaker sales, and that although GDP may be relatively acceptably strong, it does not mean that the economy is getting stronger. The economy basically is getting fatter. What is happening in the U.S. economy is that the government is spending massively, that the public debt is going through the roof, and that GDP may escape recession, but that the contraction of the private sector and the weakening of the domestic economy is evident in all of the data, from employment to population ratio, which has not recovered the levels of 2020, from the ratio of labor participation rate, which has also not recovered the levels of February 2020, to the ISMs, the manufacturing sector, etc. Weakening of the domestic private sector at the expense of the inflationary tax and monster government spending. Central banks know that there are three ways of addressing a very elevated level of inflation. The first one is to increase rates. That is what they're doing right now, but they're still behind the curve. Second is to reduce the quantity of money in the system. That means reducing the balance sheet and reducing the amount of money that is brought into the economy via credit. The third one is government spending, cutting government spending, because governments weigh between 25 to 50% of the economy in most developed economies, and therefore it is a very, very powerful inflationary tool when they spend and deficit spend like there's no tomorrow. Hence, when central banks look at ways to cut inflation, they understand that what we need to see is a reduction in aggregate demand. If aggregate demand is going to fall, but it's not going to come from a reduction in government spending, which means that 50% of GDP is not cutting spending. Think about this. The aggregate demand estimates that everybody are assuming, that people are assuming, the aggregate demand reduction is going to come entirely from the private sector. And if it comes entirely from the private sector, it means a deep recession. Therefore, if central banks start to cut rates because of a reduction in aggregate demand, when the governments of the world are not reducing their expenditure, and they mean about 50% of GDP in developed economies, then what they're actually thinking of is that they will need to cut rates because there is a big, deep recession in the private sector. So careful what you wish for. We have discussed a number of times the risk of an earnings recession. So far in 2023, we have already seen a significant downgrade of earnings estimates of those sectors that benefited from the reopening. Airlines, oil companies, all of those that benefited both from the commodity and the increase of activity after the reopening from the pandemic. However, we are also seeing a weakening of estimates in the defensive sectors. Higher taxes, weaker margins, weaker sales mean downgrades of earnings per share. In the United States, we have a factor which is massive buybacks helping earnings per share. But in Europe, that doesn't happen. Think about this. As this graph by Morgan Stanley shows, the earnings recession risk, moving earnings into negative territory, is quite significant, both on the cyclical sectors, but also on the defensive sectors. In a nutshell, what we're finding is that the very poor recovery of the economy added to increases in taxes and inflationary pressures are going to put an even bigger threat and a bigger burden on companies' earnings, and it's showing in those that are providing an outlook for 2023 and 2024. They're actually being either very vague or not particularly bullish. Central banks need to continue tightening. There is a perception, there is a narrative out there that central banks need to start cutting rates into the second half of 2023 because inflation is coming down, inflation is cooling, and the worst for inflation is already behind us. However, we need to understand, first, that core inflation continues to be extremely elevated. Second, that inflationary pressures remain all over the environment that has everything to do with services, which is the vast majority of the GDP of a developed economy. And also, because if you think about this, the narrative that central banks need to cut rates in the second half of the year is a very dangerous one. It means that a lot of people are assuming that there will be a recession in the second half of the year, and that is not good for markets. So don't bet on cyclicals with the idea that central banks are going to cut rates when the reason why they cut rates is because there will be a recession. Dangerous, no? So let's be very, very prudent about that. So far, we have not seen a debt crisis, and it's very unlikely that we see a debt crisis in 2023 with the pace of rate hikes that we have ahead of us, and also with the current environment of credit conditions. That is true. However, S&P ratings is showing that the deterioration of credit conditions and the deterioration of solvency and liquidity ratios are significant. Think about this. The number of rating downgrades relative to upgrades has been very negative, meaning that there's a lot more rating downgrades than upgrades. The reasons why companies are weakening their ability to repay their debt comes from both weakening operational performance to macroeconomic pressures, inflationary pressures, and leverage. But also, at the same time, financing costs are rising, cost of capital is also rising, and although defaults are increasing and they're higher than in 2021, certainly the level of defaults so far is not worrying. However, the wall of maturities is coming in 2025, 2026. Those are the years in which companies and sovereign bond issuers have pushed their maturities to try to benefit from low interest rates when they were. So they're going to have to refinance at a much higher rate. So the challenges of the credit market are creeping, are showing evidently, but they're not dangerous. They're not certainly at extreme levels right now. Credit conditions remain extremely accommodative. However, we need to pay a lot of attention to this because it may get worse pretty quickly as the deterioration of macroeconomic and financial conditions continue. The Brazilian economy may not grow at all in 2023 or grow less than 1%. This is yet another Latin American economy that is seeing a slump in estimates of economic growth due to the populist policies implemented by the government or announced by the government. This is extremely dangerous because it's a pity. It's a region that certainly has a lot of potential and that sees that potential being eroded by the wrong policies, interventionism, increasing taxes, increasing bloated government spending devoted to areas with no economic return. So very, very dangerous environment for Latin America. Now that almost 55% of the GDP of the region is with governments that have a very populist agenda that has proven to be a disaster in Argentina and Nicaragua or in Venezuela. So obviously we have to remember the incredible potential of the region, but we also have to remember the incredible risk, which is both on the growth side and on the monetary side. We have to be cautious in general about how markets are perceiving the macroeconomic and the monetary environment. If we look at the latest estimates of the IMF, it is true that it has upgraded global growth based on the analysis of a level of inflation that is cooling down a little bit and the idea that commodities are obviously going to be a smaller drag on the global economy. The reopening of China is critical. However, we need to be also extremely prudent because even with those revisions, global growth is going to be more or less the same as in 2008. It's going to continue to show that the BRICS, the emerging market leading economies, are going to continue to be very, very weak even with these upgrades. We also need to be aware of monetary imbalances and the risk of being too dovish about the monetary policy. A lot of people are assuming that interest rates are going to come down in the second part of the year. And that is very, very dangerous because it seems like we're back in August 2022, where there is way too much risk on appetite and too little analysis of the risks and the very little growth that we have in front of us. The environment in the market right now is extremely bullish the European Union, extremely bullish Europe stocks, very bearish US stocks. However, the earnings season so far is showing us that US companies are giving better earnings, better guidance, and certainly better margins than their European counterparts. So far, the European Stocks 600 earnings season is actually quite disappointing, to be fairly honest. So is the US one, but not as much. So betting on the European stocks right now is extremely dangerous. To start with, because it would be betting on an economy that has gone from recession, yes, to stagnation, not a lot of fun. But also because these companies have proven over time, numerous times, that they are unable to maintain their margins and increase their guidance. So if we add to that the picture of buybacks, which is positive for US stocks, but negative for European stocks, the bet on Europe continuing to increase is a valuation call that is very dangerous because most European stocks are not cheap because they don't deserve it and the market is underappreciating their growth, but they're cheap simply because they either don't grow or because they destroy value. So the idea of Europe versus the United States, very dangerous right now to me. The European Union escaping recession doesn't mean that it is escaping stagnation. It's incredibly important to understand that the factors that have made the European Union avoid recession in the fourth quarter are fundamentally external factors. A much warmer winter, less imports of oil and natural gas, and certainly lower prices of oil and natural gas. All of those things have helped. Fantastic. Okay? But that doesn't mean that the European troubles are over. The challenges for the German, the French, the Spanish, the Italian economies remain. It is still very difficult to see those economies improving to the extent that consensus requires in order to get them back into shape. Remember that things were not particularly rosy already in 2019 before the pandemic.